Imagine you have just overseen the publication of this massive 1,000-page, meticulously audited set of financial statements.
Oh, the dream scenario for any finance team.
Right. I mean, the board has signed off, the shareholders have reviewed it, and the document is basically locked in the archives. It's done.
Or so you think.
Exactly. Because a year later, during some routine reconciliation, you find a missing interest receipt. And, the corresponding tax deduction certificate just literally slipped under a digital rug somewhere.
Which is a surprisingly common nightmare.
Yeah, and you can't simply, shove those old numbers into the current year's books, right?
Yeah.
Because that totally distorts your current performance.
Right. It inflates your current year metrics artificially.
But you also can't just ignore them. I mean, the tax authorities already know about them.
They absolutely do.
So how do you rewrite financial history without, breaking the compliance framework? Welcome to a deep dive into the JAP Advisors Ind AS Clinic podcast.
Glad to be here.
We are bypassing the basics today and getting straight into the friction points of retrospective restatements.
Yeah, because the scenario you just outlined, it's one of the most mechanically complex triggers for an audit committee showdown.
A showdown is definitely the right word for it.
It is, because when a finance team discovers an omission from a prior period, their instinct is usually, self-preservation.
Right, they want to sweep it under the rug. Or just blend it into the current year.
Exactly. Just pass a journal entry today and hope nobody notices. But the framework governing Indian accounting standards is it's ruthlessly specific about how history has to be corrected.
And we are going to tear into those mechanics today. But before we do that, we have to set some boundaries for this deep dive.
Yes, absolutely. I need to establish a critical parameter for you, the listener. The views expressed in this analysis are the personal views of the author of our source material.
Right. They aren't legally binding.
Exactly. They are not binding. You are strongly requested to seek the help of an expert before taking any action or, refraining from any action based on the views we discussed today.
Got to cover our bases there.
Yeah.
So let's contextualize the source material drive this analysis. The issue we are dissecting today comes straight from the trenches.
Well, actual practitioners.
Yeah, it's drawn directly from the issue repository on GAPadvisors.com. And for the auditors and financial controllers listening, this platform is incredible. It hosts over 4,500 issues.
4,500, that is a massive database.
It is, and it has incredibly detailed standard-backed responses on Ind AS and Indian GAAP.
And anyone can access this, right?
Yeah, any person can register for free.
Right.
You just submit your own specific issues for a detailed response, and it's delivered directly to your inbox.
Which is an absolute lifesaver.
Oh, completely. It's an essential mechanism, especially for an auditor who needs, concrete documentation on how they addressed a highly specific Ind AS application.
It gives you that solid backing. Furthermore, the specific case we are analyzing today, it was featured in the 220th edition of the GAAP Advisors Task Weekly newsletter.
220th? That's a lot of newsletters.
It really is. That newsletter is authored by C.A. Manish C. Iyer, who is the director of JAP Advisors, and it's published on LinkedIn.
Right, and there are over 230 editions published to date, right?
Yeah, over 230. It provides this continuous pulse on the practical application of these standards in the real world.
Okay, so we have our source. Now we need to lock down the environmental variables for this specific case. We are operating on the standard Indian financial reporting calendar.
So April to March.
Exactly. The beginning of the reporting period is the 1st of April, and the end is the 31st of March.
Which is crucial because that hard cutoff is exactly what creates the cutoff errors we are going to be discussing.
Right. And secondly, our functional and presentation currency is strictly the Indian rupee, INR.
Okay, keeping it domestic.
Yes. Any currency other than the functional currency is foreign currency. Establishing INR as the baseline here is a very deliberate choice for our deep dive.
Why is that? To keep it simple.
Basically, yeah. It isolates our prior period error from any, compounding foreign exchange translation errors under Ind AS 21.
Right. We don't want to get bogged down in FX gains and losses.
Exactly. We are dealing with a pure domestic oversight today.
Which brings us to the actual oversight in question. Let's call it the case of the missing interest.
I love a good mystery title.
The fact pattern here is deceptively simple. A company finalizing its accounts for the financial year 2022-23 omitted the interest income on an electricity consumption deposit.
Okay, so they paid a deposit to the electricity board, it earned interest, and they just forgot to record it.
Precisely. And consequently, they also omitted the corresponding TDS.
Right, the tax deducted at source.
Yeah, the TDS that the Electricity Corporation had withheld on that interest. Now, the initial response from the Gap Advisors platform is unequivocal about this.
What did they say?
They state that this omission is classified as an error in prior period financial statements.
Okay, wait. Let's challenge that immediate classification for a second.
Sure, play devil's advocate.
Because the standard response hinges on a specific phrase, right? The assumption that the company had sufficient information available to accrue this interest.
Yes, available information is the key metric.
But in the real world, I mean, you know how it is. Utility companies are notorious for delayed statements, portal outages, opaque calculation methods.
Oh, absolutely. Getting a straight answer from a state electricity board can take months.
Right. So if the electricity board simply did not communicate this interest accrual until after the 2022-23 books were officially closed, why is this an error?
You're saying it shouldn't be penalized as an error.
Exactly. Why isn't this treated as like a change in accounting estimate or a new event recognizable in the current year since the information technically arrived late?
That is the exact argument every CFO makes when they get caught with one of these.
Because it makes sense. What exactly constitutes available information in a digital landscape where data might be generated on their end but not actively pushed to the user?
It's a fair question, but the standard doesn't care about your mail delivery issues.
It doesn't.
No. The distinction between a prior period error and a change in estimate rests entirely on the legal and constructive availability of information, not the administrative convenience of receiving a physical piece of paper.
So ignorance isn't an excuse here.
Not even a little bit. In AS 8, which is the standard governing accounting policies, changes in accounting estimates and errors.
Right. Our rule book for today.
Exactly. It defines a prior period error as an omission arising from a failure to use or misuse of reliable information that meets two specific conditions.
Okay, lay them out. What are the conditions?
First, the information was available when the financial statements for those periods were approved for issue.
Meaning it existed in the universe somewhere before the board signed off.
Right. And second, and this is the kicker, it could reasonably be expected to have been obtained and taken into account.
Reasonably be expected to have been obtained. That's a heavy phrase.
It puts the burden of proof entirely on the company. If we apply that to an electricity deposit, the company holds the underlying contract, right?
Yeah, they know they paid the deposit. They have the receipt.
They know the principal amount, and they operate under a regulatory framework where state electricity boards mandate a specific interest rate on security deposits. It's public knowledge.
So you're saying just because they didn't get a letter stating, here is your interest, they still had all the variables to do the math themselves.
Precisely. The fact that a physical letter didn't arrive in the mail does not absolve the financial controller of the responsibility to calculate and accrue that interest based on the known contractual variables.
Wow. Okay, so that implies the standard expects a proactive rather than reactive finance function.
Highly proactive. You have to go looking for your accruals.
So an auditor is not going to accept "we didn't get the email" as a defense if the variables to calculate the accrual were already sitting in the company's own master data.
They will laugh you out of the room if you try that defense.
And furthermore, because there is TDS involved here, we have another layer of proof, right? The Income Tax Department's portal.
Ah, yes. The 26AS.
Exactly. The Form 26AS, or the Annual Information Statement. That portal would likely reflect this deduction.
Almost certainly. The electricity company deposits the TDS, it hits your PAN, and it shows up on the portal.
So if the tax portal shows a TDS credit that is not mirrored in your books, the claim that the information was unavailable completely disintegrates.
It totally falls apart. The integration of tax data makes the oversight basically indefensible.
Because it's literally sitting on a government website under your company's name.
Exactly. If the TDS was reflected on a government portal prior to the board approving the financial statements, the information was objectively available.
Period. End of discussion.
Right. Failing to reconcile the tax portal with the general ledger before closing the books constitutes a massive failure in internal controls over financial reporting.
And Ind AS 8 classifies that specific failure as an error.
Yes, and that triggers a highly specific and frankly often painful remediation process.
Okay, so let's map out the typology of these errors as defined by Ind AS 8.
Mm.
Because the standard doesn't just treat an error as this one monolithic concept, right?
No, it categorizes them.
Right, it breaks down the specific ways a finance team can fail to reflect reality. The standard lists mathematical mistakes, mistakes in applying accounting policies, oversights, misinterpretations of facts, and the big one, fraud.
The F word in accounting.
Yes, nobody wants to hear that word.
Yes.
So in our electricity deposit scenario, this is neatly categorized as an oversight.
A simple, mundane oversight.
But the boundaries between these categories seem, I don't know, a bit porous to me.
How do you mean?
Well, imagine the team did see the interest statement, but they recorded the wrong amount because they misunderstood how the utility compounded the interest.
Okay, they got the math wrong.
Right, we suddenly shift from an oversight to a mathematical mistake, or potentially a misinterpretation of facts.
I see what you're saying. The label changes based on the root cause.
Yeah, but does that categorization actually matter in the end?
It's a great point. The categorization helps the auditor document the root cause for their work papers. But the mechanical correction required by Ind AS 8, it remains completely agnostic to the category.
So the fix is the same regardless of what you call it.
Exactly. Whether the variance was caused by a junior accountant's keystroke error, a fundamental misunderstanding of an Ind AS revenue recognition policy, or a deliberate suppression of income, which is fraud, the financial statements must be corrected to reflect the economic reality in the exact same way.
That creates a really fascinating operational paradox, if you think about it.
How so?
Well, the legal and punitive consequences for a CFO who commits fraud are astronomical compared to a junior accountant who just makes a mathematical oversight.
Obviously, one gets you fired, the other gets you sent to prison.
Right. Yet Ind AS 8 demands the exact same retrospective restatement mechanism for both. The accounting standard does not punish intent. It solely exists to repair the integrity of the math for the end user.
That is a brilliant way to phrase it. The standard prioritizes the user of the financial statements above everything else.
The investor, the lender, the regulator.
Yes. Think about it from the perspective of a bank. When a lender assesses the liquidity and leverage of an entity based on the 2022-23 comparatives, they require an uncorrupted baseline.
They need to know the actual number.
Right. They do not care why the interest was omitted. They only care that the retained earnings and the current assets are accurately stated in front of them.
So by enforcing a universal mechanism for correction, Ind AS 8 removes subjective leniency from the process.
Exactly. You don't get a lighter restatement penalty just because it was an honest mistake.
Okay, to understand how these errors corrupt that baseline you mentioned, we need to trace the life cycle of a mistake.
Oh, this is the fun part. Let's trace it.
Because paragraphs 41 and 42 of Ind AS 8 indicate that an error can manifest in 4 distinct operational arenas.
Right. Recognition, measurement, presentation, or disclosure.
Instead of just defining these in a textbook way, let's track a hypothetical finance team as an error escalates through these stages, using our electricity deposit as the payload.
I like this. A stress test of the standard.
Exactly.
Mm-hmm.
So at the foundational level, we have a complete failure of recognition.
The ground floor of failure.
Right. The team ignores the deposit entirely. The interest income is not credited to the P&L, and the TDS receivable is not debited to the balance sheet.
The economic event occurred in the real world, but it is entirely invisible to the financial reporting framework.
It's like a tree falling in the woods and the accountant wasn't there to hear it.
Precisely. That's a recognition error.
Okay, now let's say the auditor catches the recognition failure during the draft stage. The team goes, oops, our bad, and they attempt to correct it. But they stumble into a measurement error.
All right, how do they mess up the measurement?
They recognize that the interest exists, but they calculate it at a 5% simple interest rate instead of the 8% compounded rate mandated by the state tariff.
Ah, so the asset and the income are now technically on the books.
Right, they exist now, but the carrying amount is materially flawed.
So the user of the financial statements is aware of the asset, but their valuation models will be skewed by the incorrect measurement.
Exactly. Okay, let's push it further up the chain. The auditor points out the measurement flaw, too. The auditor is working hard today.
They really are. So the controller corrects the calculation to the precise rupee. The recognition and measurement are now absolutely flawless.
Perfect. Job done. Right.
Not quite. Because now the controller is concerned that showing a sudden spike in other income will trigger questions from analysts on the earnings call. They'll ask why this wasn't accrued in previous quarters.
Ah, they're worried about the optics.
Right. So to bury the variance, the controller nets the interest income directly against manufacturing power and fuel expenses.
Oh, no, you can't do that. This is a presentation error. The net profit at the bottom of the statement of profit and loss is mathematically perfect.
The bottom line hasn't changed.
But the presentation violates Ind AS 1, which generally prohibits the offsetting of income and expenses unless explicitly permitted by a specific standard.
Right, because the user is deprived of seeing the gross power consumption costs and the gross yield on utility deposits. You've blurred the lines.
You've hidden the true nature of the transactions. Okay, final stage. Let's say they fix the presentation. We reach the disclosure arena.
The final hurdle.
The team recognizes the interest, they measure it perfectly, and they present it correctly as gross other income.
Okay, so the primary statements are solid.
Yes, but they fail to update the related party disclosures or the fair value hierarchy notes detailing the nature of utility deposits as required by NAS 107 or NAS 109.
So the numbers are right, but the context is missing.
Exactly. Disclosure error means the numbers on the primary statements are correct, but the qualitative context required by the standard is withheld from the reader.
This escalation really highlights how an error isn't just a wrong number. It can be a correct number placed in the wrong context.
Which brings us to a clause in the standard that completely alters the risk profile for a CFO.
The intent clause?
Yes, the text dictates, and I'm quoting here, financial statements do not comply with Ind AS if they contain either material errors or are immaterial errors made intentionally to achieve a particular presentation of an entity's financial position, financial performance, or cash flows.
That intent clause is a massive trapdoor.
It really is. Because auditors rely so heavily on materiality thresholds.
Oh, heavily. Everything is driven by materiality. If an error is deemed immaterial, say it's a 10,000 rupee variance in a billion rupee revenue stream, the auditor typically waives the correction.
Because it doesn't impact the economic decisions of the users. A 10,000 rupee difference doesn't change a billion rupee valuation.
Right. It's below the posting threshold.
But this clause strips away that protection entirely if the error was intentional.
Yes. It neutralizes the defense of materiality when management attempts to engineer the narrative.
Give me a real-world example of how that plays out.
Okay, consider a scenario where a company has guided the market to expect a gross profit margin of exactly 40.0%.
A very specific target.
Yes. The preliminary draft of the financials shows a margin of 39.9%.
Oh, just barely missing the mark.
Right. Now, mathematically, that 0.1% variance might be completely immaterial to the overall balance sheet.
Sure.
However, to hit that psychological 40.0% benchmark for the analysts, the CFO intentionally reclassifies an immaterial sliver of direct manufacturing wages into administrative expenses.
So they just shuffle some expenses down below the gross profit line to make the top look better.
Exactly. Under standard auditing practices, without looking at intent, that small reclassification might fall well below the materiality threshold.
The auditor might just say, it's too small to worry about.
But because the intent was to manipulate the presentation of financial performance to meet market guidance, Ind AS 8 declares the entire set of financial statements non-compliant.
The entire set.
Yeah.
Just because of that tiny intentional tweak.
Yes. The auditor cannot rely on the materiality defense anymore. They must demand a correction, or they have to qualify their audit report.
That is intense. It essentially requires the auditor to play psychologist.
It does. They can't just audit the ledger. They have to audit the motivation behind a 5 rupee journal entry if it crosses a sensitive reporting boundary.
Which is brilliant because it prevents the death by 1,000 cuts approach, right? Where management makes dozens of tiny immaterial tweaks to smooth out earnings volatility over time.
Exactly. You can't hide behind it's immaterial if you did it on purpose to mislead.
Okay, so assuming we have identified a material prior period error or an intentional immaterial one, like our omitted electricity interest, we have to execute the remedy.
Now we have to fix the mess.
And the standard draws a hard line based on the timing of discovery, correct?
Yes, timing is everything. If the team catches the omission in, say, May 2024 while they're still drafting the 2023-24 financials.
And the error relates to December 2023.
Right. The fix is trivial. The period is still open. The board hasn't signed off yet.
So they just adjust the current year draft before approval. No harm, no foul.
Exactly. The friction only really occurs when the error is discovered in a subsequent period.
Which is our case study. The 2022-23 books are signed, audited, and published. They are out in the world.
Yes. And now we are halfway through the 2023-24 financial year, and suddenly the TDS mismatch surfaces on the government portal.
Panic ensues.
Right. And this is where paragraph 42 of Ind AS 8 introduces the concept of retrospective restatement.
Okay, break that down for me. What does that actually mean?
It means the entity is strictly forbidden from simply passing a catch-up journal entry in the current year.
So they can't just say, debit TDS receivable, credit prior period interest income in 2024.
Absolutely not. Recognizing prior period interest in the current year's P&L would artificially inflate the 2023-24 performance.
Which violates the core accrual concept.
Exactly. You are matching revenue and expenses to the wrong period. The standard demands that the entity correct material prior period errors retrospectively in the first set of financial statements approved for issue after their discovery.
So it's essentially version control for financial reporting.
That's a great analogy.
Like in software development.
Yeah.
You can't just push a patch to the live environment that corrupts the current operational metrics, right? You have to go back to the previous branch, apply the fix there, and then merge it forward so the historical record is perfectly accurate.
That is exactly how it works. And to execute this version control, Ind AS 8 provides two specific avenues for restatement.
Depending on the temporal depth of the error, right?
Yeah.
How far back it goes.
Right. So let's start with Avenue A.
Okay. Avenue A dictates that the entity must restate the comparative amounts for the prior period presented in which the error occurred.
Let's walk through the exact mechanics of this for our electricity deposit case study.
Yes, let's get into the weeds. When this company publishes its 2023-24 annual report, it is required to present the 2022-23 figures right next to it as a comparative column.
Standard practice. But they will not simply copy-paste the numbers they published 12 months ago.
Because those numbers are wrong?
Right. They will effectively rewrite the comparative column for the public.
So for the 2022-23 comparative statement of profit and loss, they will physically increase other income by the amount of the omitted interest.
Yes. And naturally, this will correspondingly increase the profit before tax for that comparative year.
Okay, simple enough so far.
But crucially, this restatement triggers a secondary wave of adjustments.
Ah, the domino effect.
Exactly. By increasing the accounting profit for 2022-23, they have now altered the tax base.
Because they made more money in the past, they technically owe more taxes for the past.
Right. They must now compute the tax expense that would have been applicable to that higher profit back in 2022-23.
Okay, so if the TDS they forgot to record actually covers the liability, the current tax provision might remain somewhat stable, right?
It might, but the deferred tax calculations under Ind AS 12 will inevitably shift.
That secondary wave is where restatements become a total nightmare for the finance team.
It's never just one journal entry.
You don't just change one line item. Restating prior period income forces a recalculation of the prior period, current tax, deferred tax liabilities, and ultimately, the earnings per share.
The EPS, the most sensitive metric for any listed company.
Right. The comparative basic and diluted EPS for 2022-23 that gets published in the new annual report will be different from the EPS reported to the market a year ago.
Which analysts will notice immediately.
And it hits the balance sheet too, right?
Oh, heavily. In the comparative 2022-23 balance sheet, they will recognize the TDS receivable under current tax assets.
They adjust the deferred tax line items.
And the net effect of that corrected income and taxes will flow straight into the comparative closing retained earnings.
It's a massive web of adjustments for one missed interest receipt.
And the standard also mandates severe transparency regarding this whole process. You can't just quietly change the numbers and hope nobody asks why the comparatives don't match last year's PDF.
Right, they have to disclose it.
Heavy disclosure. The entity must include a detailed note disclosing the specific nature of the prior period error.
They must present a tabular reconciliation, right?
Yes, a table showing the specific line items that were originally published, the amount of the correction applied to each individual line item, and then the final restated figures.
The objective being to make the restatement process completely transparent to the user.
Exactly. Allowing an analyst to update their historical models without any ambiguity about what changed and why.
That makes sense. So that covers Avenue A, where the error happened in the immediately preceding year. The comparative column is already there on the page, so we just rewrite it.
Right, but Avenue B addresses a much more structurally complex scenario.
Okay, let's read the text for Avenue B. It states, if the error occurred before the earliest prior period presented, restating the opening balances of assets, liabilities, and equity for the earliest prior period presented.
This is where things get really deep.
Let's stress test this with a more severe hypothetical to make it clear.
Hit me.
Imagine it is the year 2026. The company is currently preparing the 2025-26 financials, with 2024-25 as the comparative column next to it.
Okay, a standard two-column presentation.
Right, but then the auditors discover that back in 2021, 5 whole years ago, the company capitalized a massive routine maintenance expense as a fixed asset instead of charging it directly to the P&L.
Oof, a classic capital versus revenue expenditure error.
Yes, and they have been depreciating this fake asset ever since.
Okay, so we have a major problem. And we cannot use Avenue A here.
Why not?
Because the year 2021 is not presented in the current report.
Yeah.
You only have 2026 and 2025 on the page. We cannot rewrite a column that isn't visually there.
Right. The error originated way outside the visible comparative window.
But its toxic effects have compounded and are actively polluting the current balance sheet.
Because the asset block is artificially inflated, right?
Yes, the fixed assets are overstated, and the retained earnings are severely bloated because the company avoided taking that massive expense through the P&L back in 2021.
They basically hid a massive loss.
Exactly. So Avenue B requires the entity to execute what is essentially a surgical strike on the opening balances of the earliest period presented.
Which, in our scenario, the earliest period presented is the start of the comparative year, April 1st, 2024.
Correct. The finance team must calculate the cumulative impact of that capitalization error from 2021 all the way up to March 31st, 2024.
They have to do 3 years of historical math.
They must determine the original maintenance expense that should have been recognized, offset by the artificial depreciation that was recognized over those 3 years.
So the net sum of that massive calculation represents the total overstatement of historical profits.
Yes. And the company must then forcefully reduce the opening retained earnings balance as of April 1st, 2024 by that exact net amount.
And they must simultaneously de-recognize the carrying amount of that false asset from the opening balance sheet.
It's a brutal correction.
And this creates a massive point of friction regarding dividend distributions, doesn't it?
Oh, absolutely. This is where it gets legally messy.
Because retained earnings is the legal reservoir from which dividends are declared under the Companies Act.
Right. You can only pay dividends out of actual profits.
So if the company declared aggressive dividends in 2022 and 2023 based on those bloated incorrect profits, and now the retrospective restatement via Avenue B suddenly shrinks that opening reservoir,
They could theoretically push their historical retained earnings into a deficit.
meaning they paid out dividends they legally didn't have the money to pay out.
Exactly. And that is the exact systemic risk Ind AS 8 is designed to expose.
It forces the truth into the light.
If a prior period error artificially inflated the dividend capacity, the restatement forces the reality of that capital erosion to the surface. It completely prevents management from permanently hiding a historical loss simply because the financial year has closed.
Wow. Okay, but furthermore, when Avenue B is utilized, when these opening balances of the earliest comparative period are restated, doesn't Ind AS 1 impose an additional requirement?
It does, a rigorous one. The presentation of a third balance sheet.
The third balance sheet. This sounds ominous.
It is the ultimate structural consequence of a deep historical error.
Because normally, a company only presents 2 balance sheets, right? The end of the current year and the end of the comparative year.
Standard practice, yes.
Yeah.
But if you fundamentally alter the opening balances of that comparative year via Avenue B, you have broken the visual continuity of the financials.
Because the closing balance of 2024 wouldn't match the opening balance of 2025 anymore.
Exactly. To bridge that gap, Ind AS 1 requires the entity to present a full balance sheet as of the beginning of the preceding period.
So in our 2026 scenario, the annual report would feature 3 columns for the balance sheet.
Yes. March 31st, 2026, March 31st, 2025, and the restated baseline of April 1st, 2024.
3 columns. That is a highly visible signal to the market.
Oh, it screams, we messed up.
Yeah.
The third balance sheet provides the user with the uncorrupted foundation upon which the comparative year's performance was built.
It visually isolates the cumulative effect of the historical error from the operational performance of the comparative year.
It is a giant red flag to the market that a significant structural correction has occurred to the historical capital base. You cannot hide a third balance sheet.
Okay, so returning to our source material from the Gap Advisors Ind AS Clinic, the resolution to our electricity deposit case is mathematically straightforward but procedurally incredibly rigid.
Yes, the framework is unforgiving.
The omission was a failure to use available, reliable information. Therefore, it is definitively a prior period error.
The company cannot process the interest in the current P&L. They are legally required to apply retrospective restatement via Avenue A.
They will adjust the comparative 2022-23 numbers, recalculate the associated tax metrics, adjust the comparative EPS, and heavily disclose the nature of the oversight in the notes.
The standard enforces discipline above all else.
Because by making the correction process so highly transparent and mechanically arduous,
Right. Forcing recalculations of taxes, EPS, and those comparative columns.
it heavily disincentivizes finance teams from taking a relaxed approach to period-end cutoffs.
It essentially says, get it right the first time, or your life will be miserable next year. It demands that the financial statements reflect a precise chronological reality, not just a smoothed-out, convenient narrative.
And the mechanics of Ind AS 8 really force us to reconsider the definition of reliable information in our current, rapidly accelerating data environment.
Oh, absolutely. The landscape has changed.
As ERP systems become deeply integrated across global supply chains, and as API feeds replace monthly physical plus statements, the sheer volume of data generated before the board approved the financials is staggering.
It's a tsunami of data.
The pressure on the auditor and the controller to guarantee that every single piece of available information has been accurately captured, measured, and presented is immense.
Think about it. An automated flag in a subsidiary's inventory module might constitute available information under the strict reading of the standard.
Right. If a human fails to action that automated flag before the cutoff,
It is a prior period error, triggering the entire machinery of retrospective restatement we just detailed.
the standard basically assumes a level of omniscience over the entity's entire data infrastructure.
Which is terrifying. And as that infrastructure scales, the operational cost of compliance scales proportionally. Finance functions really must transition from manual month-end reconciliations to continuous automated auditing.
And they have to catch it in real time.
They do, to prevent these oversights from crystallizing into NAS 8 errors.
And that systemic evolution is exactly why continuous education on these standards is non-negotiable. You can't just learn it once and be done.
The rules stay the same, but the application gets harder every year.
Well, we want to sincerely thank you for dedicating your time to this deep dive today. Navigating the friction between theoretical accounting standards and real-world data flow gives you a distinct analytical advantage.
I completely agree. And if this breakdown of Ind AS 8 mechanics provided value to your practice, we request that you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on your preferred platform.
Whether you listen on Spotify, Amazon Music, or YouTube, ensuring you receive these updates is critical for maintaining technical proficiency.
It's the best way to stay ahead of the curve.
We also strongly encourage you to share this deep dive among your professional network. Send it to your contacts, colleagues, audit partners, and internal finance teams.
Use it to stress test your own internal controls around period and cutoffs. Ask your team, would we catch the missing electricity interest?
Crucially, we ask that you forward this to students currently pursuing their CA course. The curriculum provides the foundation, but understanding the cascading tax implications, the necessity of the third balance sheet, and the friction of restating retained earnings.
That is where theoretical knowledge transforms into practical, highly valued expertise.
Spreading this knowledge on the application of Indian accounting standards is vital for the integrity of the profession.
It elevates everyone's game.
Keep interrogating the source data, scrutinize your opening balances, and continue seeking clarity in the numbers. We will see you on the next deep dive.